In October 1929, the stock market didn't just fall, it evaporated. Between September 3rd and November 13th, the Dow Jones lost 48% of its value. But here's what they don't tell you in the history books. The wealthiest families in America, the Rockefellers, the Kennedys, the Mellons, didn't lose fortunes. They multiplied them. How? Because most people think a crash is a sudden, unpredictable catastrophe. But a real crash is a scheduled wealth transfer event, and the ultra-wealthy had already bought their tickets 18 to 24 months in advance. Right now, in 2025, the exact same mechanisms are quietly grinding into place. The same patterns, the same lead time, the same playbook. This isn't speculation. This is forensic financial history. And if you don't understand the autopsy of 1,929, you're about to become a statistic in 2026. Let's start with the architecture of failure. In 1929, the crash wasn't caused by stocks being overvalued. It was caused by what economists now call a Minsky Moment, the point at which debt can no longer be serviced by income, only by selling assets. And when everyone tries to sell at once, the system implodes. Here's the sequence. 1927 to 1928. Credit expansion. Margin debt explodes. Retail investors are told, this time is different. Sound familiar? Early 1929. Insiders, the Joseph Kennedys, the Bernard Baruchs, begin quietly liquidating equities. Not all at once. Slowly, methodically. They convert stock positions into cash and short-term treasuries. September 1929. The market peaks. Retail investors are still buying. The ultra-wealthy are already in position. October 1929. The selling begins. Margin calls cascade. The asset correlation breaks down. Everything falls together. Stocks, bonds, real estate. The only thing that holds value? Cash and government-backed instruments. And here's the data point no one talks about. Between 1,929 and 1,933, deposits in the U.S. Postal Savings System, a government-backed cash alternative, grew by over 800%. Why? Because the wealthy knew that in a systemic collapse, the safest asset is liquidity in a non-failing institution. Now let's diagnose the present. Corporate debt to GDP, at all-time highs. Derivatives exposure, over $600 trillion globally, 10x global GDP. Commercial real estate, delinquency rates spiking, especially in office and retail. We are not in a bull market. We are in the final phase of a credit supercycle. And the ultra-wealthy, they're already moving. Here's the key concept. Derivatives collapse. Underlying assets survive. Let me explain. A derivative is a claim on value, a stock certificate, a bond, a leveraged real estate investment, a 401 CAC. These are financial abstractions. They only hold value as long as the system that guarantees them remains functional. An underlying asset is tangible, productive, and institution-proof. Farmland. A skilled trade. Physical gold. Water rights. A functioning supply chain. Radioactive in 1929. Margin leveraged stocks wiped out. Corporate bonds defaulted. Urban real estate on debt foreclosed. Underlying in 1929. Debt-free farmland retained value. Skilled mechanics, electricians, carpenters stayed employed. Physical cash and postal savings. Preserved purchasing power. Now apply this to today. Radioactive in 2025. Tech stocks trading at 40x earnings. Junk bonds in zombie companies. Leveraged commercial real estate. Crypto speculation without utility. Underlying in 2025. Productive agricultural land. Hard skills. HVAC, plumbing, electrical, medical, treasury, direct accounts, outside bank balance sheets, physical stores of value, gold, silver, tools. The ultra-wealthy understand this distinction viscerally. That's why, 18 to 24 months before a collapse, they begin a systematic rotation. Phase 1-1, 8 to 24 months out. Reduce equity exposure. Increase T-bills and money market funds. Phase 2, 1-2 to 18 months out. Acquire distressed debt positions. Prepare to buy productive assets at 30 to 50 cents on the dollar. Phase 3, crash. Deploy ammunition cash reserves into undervalued, income-generating real assets. Cut to historical photo. Joseph Kennedy sitting at desk. Joseph Kennedy made the bulk of his fortune not in the 1920s boom, but in the 1930s bust. He entered the Depression with liquid capital. He exited it owning distressed real estate, media companies, and infrastructure. The crash wasn't a catastrophe for him. It was a scheduled shopping event. So what do? Let's build the institution-proof playbook in layers. Layer 1. Cash safety hierarchy. Not all cash is equal. In a banking crisis, counterparty risk becomes existential. Here's the 1929. Inspired hierarchy. Updated. 1. Treasury Direct. TreasuryDirect.gov. T-bills. Held directly with the U.S. Treasury. No bank intermediary. No FDIC limit. This is your ammunition. 2. FDIC insured accounts. Under $250K per institution. Spread across multiple banks if needed. This is your liquidity buffer. 3. NCUA insured credit unions. Often more conservative than banks. Secondary reserves. 4. Physical cash, small bills, 2 to 4 weeks of expenses. For when ATMs stop working. Why T-bills specifically? Because in 1929, when bank runs started, those holding government-backed instruments didn't lose access to capital. T-bills are liquid, safe, and accepted as collateral even in systemic breakdowns. They're not just cash. They're institutional ammunition for when assets go on sale. Layer 2. Acquire underlying assets now. Don't wait for the crash. Start building your base of institution-proof assets today. Skills, HVAC certification, electrical work, welding, medical training. These are monetary translation skills. They convert labor into value regardless of the financial system state. Productive land, not luxury real estate. Farmland, water access, timber, food production, tools and equipment, a welder, a tractor, a well pump. These hold value because they produce value. Community capital, relationships with local producers, farmers, builders, mechanics. In a collapse, trust networks become currencies. Layer 3. The distressed debt position. Advanced. This is for those with capital and sophistication. The ultra-wealthy don't just survive crashes. They profit from them by positioning in distressed debt. Before the collapse. Example from 2008. Institutional investors bought residential mortgage-backed securities at 20 to 30 cents on the dollar in 2009 to 2010. By 2015, many of those positions had returned 300 to 500%. In 2025, watch for commercial real estate debt, especially office buildings, municipal bonds in over-leveraged cities, corporate bonds in over-leveraged zombie companies, but only if you have 1. Liquidity to deploy. 2. Patience to wait 3 to 5 years. 3. Legal. Financial sophistication to navigate bankruptcy structures. This is not for beginners, but it's exactly what the 1% are positioning for right now. So let's bring it full circle. The 1929 crash wasn't a random accident. It was the inevitable outcome of a credit bubble meeting a liquidity crisis. And the wealthiest Americans didn't panic, they prepared. They converted volatile assets into stable ones. They held cash in safe institutions. They waited, and when the dust settled, they bought productive assets at generational discounts. Crashes are scheduled shopping events for the prepared. Right now, in 2025, the same patterns are forming. The same lead time, the same quiet rotation from risk to safety. You can either ignore the forensic evidence and hope this time is different, or you can study the autopsy, understand the mechanism, and position yourself accordingly. History isn't the past. It's a running diagnosis of the present. Subscribe so you don't become the next case study.